Yeah.
We don't actually have a chair right now, but we would like to let Curtis say something and then we'll begin. Curtis?
Well, this is my first meeting. Thanks for allowing me to be a part of this team. I'm looking forward to these meetings. It's 4 times a year, so thank you for welcoming me. Um, as just to kick things off, I'd like to, if he wants to accept the role, to nominate Art Wallace as the chair of the subcommittee. I think his vast experience working with the Department of Finance and his personal work experience, leads him to be a good choice for someone to lead this committee.
So I'm going to go ahead and second that, although I'm not technically on the committee, we'll then ratify this at the next meeting when we have the full. I'm not sure where the Board of Ed is. Are just for members of the public, the Board of Finance has a duty to consult with the Board of Education. They're not technically required to be here. It's good for them to be here, but this still will serve the purpose of consulting with them. They were given the opportunity. So, Art, if you're willing to serve, we'll do it by consensus. Are you so willing?
I am, and I appreciate the motion. I appreciate the opportunity here, and yeah, looking forward to contributing to the group.
Well, so I guess would you lead this to say all in favor, or who takes the lead on this?
All in favor, please say aye. Aye. Okay, you are technically elected. We'll ratify that at the next meeting as well.
Okay.
Great, I appreciate it, and this is my first meeting as well, so uh, please go easy on me, and I'll take any and every opportunity for people who want to give me a hand with this process. So,
Right. So should I start here? Should I share my screen? And I'll give a brief introduction if that works.
yeah, go ahead, please.
Uh, Perfect. Everyone see this okay?
It's coming up. Yep, there it is.
Perfect. So again, for the newer folks, Tyler Polk, a partner and senior consultant at Fiducient. We're out of Windsor. Technically, I'm on the fifth floor of the Bradley International Airport parking lot. So that's why I'm not on video. I'm on my way to Houston, which is, as I mentioned before, going to be a warm 40-degree temperature. So it'd be a little breath of fresh air from what we get in here. But I focus on the defined contribution side of the house. So I typically go through the defined contribution plan, and then I'll pass it over to Dan Duffy, my colleague, who'll talk a little bit about the performance as I rush to TSA, and then and then Chris will go through the rest of the presentation. But this is our cadence from a governance standpoint. So as you can see, we'll meet quarterly, and then obviously we're always reviewing the investments and looking at the performance of the investments and making sure they're in line with expectations. But each quarter has a different fiduciary focus. We start the year with the sort of fee focused review. We then move into a investment focused, meaning are we offering the right types of investment options to plan participants? Third quarter is when we look a little bit at plan design and demographics and do a cybersecurity review of the record keeper. And then this quarter is when I give you an update from a regulatory standpoint. And we also include the investment policy statement, which we do try to follow as closely as we can. And we think it's good practice to review that every year. So I'm going to actually go to full screen mode here. There we go. Okay, so a couple things from a regulatory standpoint that we're seeing. One, the top one there is we review the 401A and the 457. The Board of Ed probably has a 403B plan as well with multiple vendors. What we're seeing coming down the pike with respect to legislation is the allowance of collective trusts in 403Bs. And just a reminder, collective trusts, these are investment vehicles held at a bank that give you access to lower cost vehicles in an institutional setting, lower cost than the typical mutual fund. And so we will, as this evolves and as the legislation evolves, we'll bring to you, obviously, if there's opportunity, collective investment trusts that could be offered to plan participants, which just again lowers overall investment cost of plan participants. The second there doesn't impact your plan. It just gives you a mindset of Washington right now. It's what's called the Auto Re-enroll Act, which would allow a layer of protection for plans if they opt to re-enroll everyone in an opt-out fashion into the retirement plan. So again, the Senate introduced a bill that would allow for plans to re-enroll people into plans every 1 to 3 years, meaning if you decided to not contribute to the 457 or a 401k or 401a, you would be opted into the plan and have to proactively opt out of the plan. I think this gives you an idea of what the government is looking at right now with respect to a challenge in the retirement space and the fact that a lot of people are, deficient with respect to their retirement, and they believe that auto features, auto re-enroll are a better way of getting at this. And then the last thing I'll touch on, and then I'll touch on one that's off paper here, but the president currently signed an executive order democratizing access to alt investments in 401ks, 401as, 457 plans. All this means is that it's a statement by the current administration around allowing for things like private equity, things like hedge funds, things like cryptocurrency into retirement plans. It doesn't force us to say we have to offer these investment options in the plan. It just says that we can. I think right now, if you think of a defined contribution plan and you think of private equity, typically private equity has higher fees, potentially liquidity constraints, and then obviously potentially litigation risk. So, we don't necessarily see this as an opportunity to add private equity as a sole option in the retirement plan, but we may start to see private equity enter into the landscape and potentially, maybe through target date funds and other investment vehicles, we may start to see private equity in the defined contribution space. The other thing that's off paper here is the government is looking at litigation reform. They see that there's a lot of frivolous litigation around the defined contribution space, particularly in the 401k, and they do want to limit that because they do see that as a detriment to the retirement industry as a whole. And so, we've seen a few representatives introduce bills like the ERISA Litigation Reform Act, and so we may start to see some further protection for committees like this around lawsuits down the road. But as you can see, the trends have been as far as litigation have increased. The biggest one I'll touch on is forfeiture claims. Just a reminder what forfeiture dollars are. If you have a vesting schedule, either in a 401k or a 401a or a 457 or 403b plan, that's just if you have a vesting schedule where people earn the amount to get employer dollars over time. When they leave, they forfeit those dollars into an account, and plan sponsors, fiduciaries can use those dollars to offset further employer contributions. But they can also just give it back to people. And there's been a flood of litigation recently that says, well, if your job is to act in the best interest of plan participants as a fiduciary, the only decision you should have is just to give it back to everyone, as opposed to offset your employer cost down the road. And so the DOL has made it very clear that they believe that you're allowed to do that, but we have seen a sort of, we as the industry, not as fiducian, have seen lawsuits around forfeiture dollars and the use of forfeiture dollars. Most have been dismissed, but we just want the committee to be aware that this is going on. And I think a lot of what the ERISA litigation reform is targeting is a flood of litigation around forfeiture dollars. I'll pause there. Any questions so far? Yeah, Lisa.
What does Simsbury do? Do we return it to the employees?
No, we use those funds towards the employer contributions. I believe we looked at the plan document and that's what it states.
Yeah, and that's important, Lisa. And what we've been hearing from ERISA attorneys is that as long as the document allows for that and says that you're able to do that, you should be protected. I think the bigger protection is you're not $120, $200 million plan. That's the big target, right? The amount of that is not necessarily being it would not be a target for any plaintiff's attorneys, but it's something that obviously you should be aware of, and I don't expect there to be litigation around it for the town. I actually expect the litigation to slow down around forfeitures given the amount of dismissals, but it is something to be aware of, and I think the document does protect you there as well.
Tyler, who wrote that document? I don't think anyone on this committee was part of that. Is that document done by the Board of Selectmen and the Board of Ed in devising their plans?
It was done by the record keeper.
Well, which policy board approved it?
It's it would be the plan design document. So however the document is designed around eligibility and employer contributions, it would be embedded in that document. We can have that brought to the 17th meeting if that helps.
Yes, that would
Um,
be helpful. And
yeah.
then we can consult with our council as to who is responsible for that document, which policy board. And
Um,
I
whether
believe I
that's,
have a copy of it, so I can send it out in an email to everyone.
I will say for the 457, the larger plan, our vesting schedule is immediate. So we don't have currently forfeiture dollars in the larger plan. Some of the
Okay.
smaller plans that didn't have that in place have a small balance. And we review that, I think, as Tyler mentioned, at least once a year during our fee focus quarter as well.
okay, great. Thank you.
we include this page just to remind the things that are best practice around the oversight of the retirement plans. Again, I think we check a lot of these boxes, right? You're meeting, you establish quorum, you meet periodically, the governing body evolves. Excuse me. A lot of this ties to our governance calendar. So, last quarter we reviewed communication, education, device services, plan design, and then next quarter we'll take a deep dive into how the fees will work. Are they reasonable? Benchmark those fees. Evaluate the record keeping services, and then we do a cybersecurity a review and outline the protocols there every year as well. So I think we're in good standing there. And then we do include the investment policy statement here. We draft this to keep it broad enough never to paint you into a corner, meaning, none of the language says that you have to remove a fund if they don't hit certain milestones. A good example is sometimes we see an investment policy statement that says if the fund doesn't outperform an index over a 5-year period, well, an index fund will never outperform an index over a 5-year period. So we'd be removing index funds. And so we like to keep it very broad, but specific enough to outline the roles, responsibilities, as well as protocols if we are to replace, remove, freeze investment options. That's all outlined here. We review it internally, and there's no recommendations to change it. And given any of the changes in the legislative structure or trends in the litigation space. And with that, I will pass it to Dan and try to catch my plane if that's okay.
Great. Well, thank you and safe travels.
Thank you very much.
Have a safe flight, Tyler.
Thank you.
Thanks, Tyler. So with that, I'm going to bring up my screen now and take over that. So hopefully everyone now is able to see my screen.
It's coming up.
Oh,
There we go.
we're there. Okay, great. I'm going to go full screen as well. Hopefully it's cooperating. There we go.
Yep.
It was great. Okay. So we're going to start off with the plan balances, starting on the 457 plan. We see the plan here right around $20.8 million in assets as of quarter end, up from the end of March, where we were at right around 18.4 million. Around 20%, so a fifth of our assets reside in our target date funds. So those are our T. Rowe Price target date funds. Those are the age-based funds that participants invest in based on their anticipated retirement date. Going down, we do see a fair number of participants invested in domestic equity. Around 30% of our assets reside in that S&P 500 Fidelity 500 fund. We have around 11% of our assets in the T. Rowe Price growth stock. And then for those that want that stable value or a capital preservation approach, we do see 18% of participants invested in our stable value option, which is that Mission Square Plus fund. One thing that we do like to point out is that participants aren't moving their money within the plan for the most part. They are doing that set it and let the market dictate. So they are assuming their allocation and not taking bets based on how the market is moving. We are seeing a lot of consistent allocations towards those asset classes and not a lot of movement between funds in those varying asset classes. So what we want to see in a DC plan is that long-term approach, and participants are largely doing that.
And I think you guys referred to this earlier, but I assume that Mission Square funds, I mean, that's a big allocation, right? Like the other big allocations, an index fund, which is a little bit more straightforward. I assume our normal process that we just referred to of looking at funds and making sure their performance and their fees are reasonable, that fund is appropriately scrutinized.
Yes, and every quarter we have all of these funds. We're going to go through that. Their performance numbers, we compare them against their respective indices, and then where applicable against peer groups. And then just, every second quarter, as part of our defined contribution governance calendar, we do a deeper dive into that Mission Square Plus fund because it is a capital preservation insurance-backed product. We go through the underlying holdings and make sure that we're still comfortable with the strategy, which we have been historically. Again, we're going to look at the performance and very, very competitive returns when we're looking at the benchmark.
And just out of curiosity, the participants in this program, do most of them also have a DB plan as well, or are they just solely DC?
Chris, I don't know if you have a little bit more insight into that. I would assume that most have some sort of DB allocation.
Yeah, it's a good question, Art. We could get you the particulars. I think there's some overlap across. I don't know that it's total, but there's some measure of overlap. I'm just trying to remember the circumstances of the different bargaining units and who's eligible for, pensions and whatnot. So I think it's a little bit of mixing and matching, but we can get you the particular data and share that.
Okay, yeah, not a rush, but that would be just good to know for background.
Sure.
Okay, thank you.
Great. Just taking a note real quick. Great. And we do have balances on the other plans here on the defined contribution side. So similar story, most of our assets reside within those target date funds, a little bit more here in our stable value fund for the Board of Ed. And then we also have some allocations here within domestic equity. But again, what we're seeing in all three of these plans is no big shifts to different asset classes, no shifts between funds, which means that participants have set those allocations and have largely stayed the course no matter what the market conditions have been. Any questions there on the fund balances?
Any questions?
Oh, sorry.
No, I think we're good.
Great. Shift forward here into the fund performance. For those that are newer to the group, I'm just going to highlight sort of how we look at this up from the DC side. So here we have all of our different funds options. So those are going to be our top lines. Those are different target date funds. We have that for all of our other core menu investment options as well. Right underneath there, we have the respective index that we're comparing against for performance. Then we have the peer group median return. So that means that for all 2005 target date funds, we get that peer group median for all of those within its peer group. And then we show what it's ranked against its peers. So in the top 50th percentile, you're going to see that green color. Third percentile, you're going to see some of that yellow. And then if it's in that fourth quartile, it'll be that darker orange. So what we notice here for the T. Rowe Price target date funds, largely outperformance over both the short and long term. You will see a little bit of noise here in the short term when we get out a little bit later into the vintages here. These have a higher equity allocation, and they have a bias towards domestic equity versus international equity. Over the last year, international markets have far outpaced domestic markets. So they do have a little bit of underperformance when we're looking at peers in that short term, so that quarter and 1 year number. However, you can see that some of that bias towards the domestic side has paid dividends, looking at those 10-year return numbers, largely within that top quartile and in some cases top decile and top 1% when we're looking at peers. So participants are getting those long-term sustained results. And again, these 10-year numbers are annualized returns. So this means that every year that fund is returning 6.3% for that 2005. And then
and Dan, I assume all the returns are net of the fees?
Yes, all the returns shown here are net of fees.
Okay, great. Thank you.
And the last thing I'd just like to point out is we look at our expenses at least once a year in terms of how we're doing our fee disclosure. We also have them on this page for the quarter. You can see here 34 basis points, looking at peer groups right around 66 basis points. So we're getting that really, really strong performance for a much more efficient price point than what we're seeing in the market. So we believe that participants continue to be well served with these T. Rowe Price target date funds. Any questions there on the target dates before we get into the core investment options?
Any questions? I think we're good.
Great. So the first fund here on the core menu, Art, thank you for the tee up, is looking at our Mission Square Plus fund. So we have this against what we call the Morningstar US Stable Value Index. What we do is we take the top providers in the stable value universe and we average out their total returns for the overall these time periods, and we compare our stable value fund to that. You can see either in line or beating the benchmark over all of our time periods. A lower expense ratio of 52 basis points. Some of these stable value products, when they're insurance backed, they have expense ratios north of 1%. So we are seeing a consistent, stable, and good return for this fund. So participants have been well served. Moving down.
Are you saying because we don't show a median on this one, like could we show like a normal expense ratio?
So we would have to look into that, because a lot of times these insurance backed products, we know what their expenses are, somewhere between 1% and 2%, but they're not obligated to report on them. So it's harder to get some of that information. Mission Square has been able to provide that for their fund, but a lot of the universe providers try to keep that internally.
Okay. Got it. Real quick aside, just on this topic of stable value, just because it's a pretty large allocation. Yeah. I think it's typical for people who work for municipalities to be sort of risk averse and put a lot of money into these funds. How often, and this is not completely related to the fund lineup here, but I'm just curious, how often do we have like education on asset allocation and taking risk and all that kind of stuff? Because it's just so important when I see with people who have a DB plan and then they're putting a lot in a stable value, allocation. And not to say that that's not a personal decision that someone can make, but how often do we educate people on just the whole investment process? And if that's something we should take offline, I'm totally fine to do that. I personally, as we go through this process, I'm going to focus a lot on the stable value stuff, just because it is such a big allocation and it's such a low risk, investment, that I just want to make sure that constituents and the role we should be playing in education and otherwise is appropriate.
Yeah, perfect. I don't have the exact number of dates, but I do know that Mission Square, the plan's record keeper, does offer education dates. So maybe we take it offline to look at historical.
Yeah, why don't we do that? That'll just be an aside for us at some point at a future meeting or otherwise.
Perfect. Awesome. Sounds great. So the next asset classes here are fixed income. We see here we have a low cost Fidelity US bond index at 2.5 basis points, doing exactly what we want for that indexed option to be doing. It's tracking its benchmark over all time periods. We have Dodge & Cox Income, so this is our actively managed Core Plus fund, trying to add some alpha or some excess return over longer time periods. We see that it has done so. So on a 5-year basis, the Bloomberg Ag down around 40 basis points. This fund has returned 1.1% annually over that time period. So significant outperformance for plan participants. You will note here we have our manager statuses. This fund was placed on a discuss status for this quarter. We just want to bring up that Jim Dignan, a member of their committee and their investment committee, has announced that he's going to be leaving the firm in June. They have a very deep roster, and he is just one member of that investment committee. He is not the lead portfolio manager. He is not necessarily fully in charge of that fund, but when there is some sort of change or some sort of action that happens within the fund, we just like to document it, that we've gone through it and reviewed it. Again, no concerns on our end, but we're just going to continue to monitor his transition off of the team and see how they replace him.
And I assume there's nothing else associated with his leaving, like there was an investigation or anything along those lines?
No, this was a planned leaving. And again, we were told this a few months ago. So this is a 7 to 8 month lead in terms of time frame for him to be leaving the firm.
Okay.
Now, are they required to tell us when there are changes such as those?
So when it happens, we notify you, and they do notify the public when that happens. They're not obligated to give us that much lead time. However, we appreciate it because it allows for us to dive in and monitor a little bit more and make sure that transition goes smoothly. Chris, I don't know if you wanted to
Yeah,
add something?
I was just going to say our research teams are, the underwriting process is a fluid one, right, and a dynamic one. So they are having those conversations at least quarterly with all of the managers that have capital on your participants' behalf. And certainly one of the queries is the makeup of the team, its composition, any succession planning, any departures, the reasons why. And I think, as Dan mentioned, in Dodge and Cox's case, they've always been pretty transparent and thoughtful when there are changes on their investment teams, and this is another circumstance of that. So we do monitor it, and we do keep tabs on it, and to the extent that some type of a personnel change might influence the investment process, that would certainly be something that would garner even more attention, and we would obviously share that with you in real time.
The question I have is there anything in the documentation that requires them to tell us that? Because, sometimes when things are going well, people will tell you. And when things, we're planning for downside. So do we have things like change of control or change in makeup of team that they're required to disclose to us?
In some of their, regular filings quarter to quarter, right there, I'm not a lawyer, right, but there's typically an honest intention from the investment management firms to disclose those changes. I would say we marry that again to our due diligence process is kind of so thorough. And I think, we're going to see that in real time. And the relationships we have with all these managers, as you may surmise, is such that they're going to let us know as well proactively, right? The good managers want their consultants to know what's going on and why. And it's something I think that's researched pretty consistently. And, I think something that we probably cover pretty well and get you the information as we know it.
Thank you.
Yeah, I just want to point out, when we have a fund move to a new status outside of that maintain, we do produce a flash memo highlighting the rationale. So that is included in the report for all of our documentation. So we have the full rationale. We discussed it there, but we have the full write-up as part of that report as well.
Got it. Thank you.
Thank you.
And just a couple other funds just to hit on really quickly. MFS Value, we'll see some underperformance here. Long-term numbers still relatively in line with its benchmark. This is a higher quality large cap value manager. So when you think of the rally that's happened in the last 3 to 5 years, it's largely been in those tech, community discretionary, those magnificent 7 names. MFS Value, being a value manager, doesn't hold any of those type of holdings. It is more of a defensive stock. So it's not going to take part in a rally where it is more concentrated in those tech names. You'll still see, even though it fell out of favor for the last few years, its track record still keeps it pretty well in line with the benchmark. Conversely, here you'll see good performance out of our large cap growth fund when looking at peers, strong performance. Again, you will notice this one was placed on a watch status last quarter. So this fund was placed a little bit more elevated onto watch because their lead portfolio manager, Joe Faith, ended up leaving the firm. He owns the track record, this 10-year track record, 5-year, 3-year, and so on. He's been at the firm leading that portfolio management team for 11 years. So what we're doing is we're doing a little bit more in-depth monitoring and making sure that that transition goes even more smooth than the Dodge and Cox, because he was a large decision maker in terms of that overall strategy. Not recommending any changes or a move to a terminate status, but again, a little bit more scrutiny than the discussed status when we see a lead portfolio manager end up leaving that owns most of that track record. Most of the underlying team is staying in place. Their associate portfolio managers are taking on that lead PM responsibility. But because, again, that lead is leaving, we just want to make sure that change goes smoothly. There's no questions there. Going down the rest of the fund menu, you will see, again, underperformance here in the short term for Eaton Vance Atlantic Capital. This is a more diversified approach. So I like to go back to this page actually for this fund. You will see in periods where there is concentrated rallies back in 2020, in the last couple of years, it struggles. But when the market is down, so when it was down 26%, it was only down 8%. when there was more of an unconcentrated rally in 2021, returning 22% on that annualized basis versus the benchmark at 5%. So yeah, when these low quality, unprofitable stocks are leading the way like they have been the last few years, this fund is not going to participate in that rally. It is more broad-based in its nature, so we understand why it's underperforming in the short term. But when we look at that long-term track record, we are seeing strong performance when the market's more in its favor. So we're not concerned, and we're not moving that from anything from a maintained status, but just like to point out, because some of these numbers don't look great in the short term, that we understand why it's happening. And we think that when the market turns, it'll be more in its favor.
So Dan, just so I'm understanding it, are you saying that for this, and I think you had similar, words you were using for the MFS fund, it's more that they're sort of like bespoke, I'll call them, strategies. So it's hard to have like a real good apples to apples on a median. Am I understanding right? Like the reds aren't a normal red? Because like I always, when I'm on these types of committees, it's always, I think everybody should take notice when there's a lot of red somewhere where there's no green at all, like on the MFS one. But it seems like what you're saying is that it's a little bit misleading because there's not like the way we're managing, like the way we're measuring to a median is not as apples to apples as like, another large cap fund or something that's more plain vanilla.
Yeah, I would, Dan, I can jump in here too, but add on. That's a great point, Art. And I would say that, right, that median result captures a continuum of approaches within the category, right? And to your point, there's nuance across those approaches. So that direct comparison performance of the fund to that median could be a little clouded. And I think that's why we try to kind of, some of the color Dan's providing around the nature of what's worked in markets, right? And the approach of the manager is important. And I think your point's well taken, right? That you guys got to be careful. I think with some of those comparisons, it's not a perfect apples to apples exercise, but I do think what we try to do, and you see that, I think, when you kind of maybe turn your attention to some of the longer dated numbers, right? The research teams are underwriting to the full return cycle, right? So they full well know there's going to be particular periods along the way where their particular nuances and orientations are not being rewarded, right? And we understand that and we anticipate that. And to the extent that over the long haul, we get a collection of different return environments, some which obviously are very conducive to the manager, which is obviously the motivation to have them in the program, that over a full cycle, those numbers start to come back and present, more favorably versus benchmarks and medians. But you're right, that the median, the peer groups they're not perfect animals, right? They're a good place to kind of start the conversation and the evaluation, but there is a continuum of strategies within it. Some very aggressive, some less aggressive, some with different types of orientations. And our research teams understand that. And I think we got to do the evaluations, as I mentioned, right, with the benefit of trying to be patient and disciplined with managers, knowing that even the very best managers, they stub their toes, right? And we don't have it in the booklet here. We could share it if there was an interest. Our research team warehouses and custody some data that looks at top quartile performers over long periods of time. And even the very best managers, invariably, a majority of them over those longer term cycles have these periods, right, where they're below median.
Yeah,
right?
no, and I get that. Like, you're not going to flip into these pages and see all green. Like, that would be, that would be virtually impossible. I guess, but if you flip back to the MFS one, I don't think there's any green, right? If I remembered right. So, I just think that maybe in the minutes we should just be clear. Like, if our argument for some, because I don't know, if a participant saw this, they might say, why are you calling this maintained? Like, it's got no green at all on it. Why aren't we thinking about replacing? And if the answer is, well, this fund is actually performing the way it should, and it's really hard to sort of pick a median for this one because there really is no apples to apples, and everything that Dan had described is actually happening the way we would expect it to for this fund. We should just make sure that it's minuted appropriately so that if that question ever did come up, it's clear that this committee looked at it and made the appropriate, sort of decision off of that. That's my only point, is that, like, I think your commentary here is very rich. Let's just make sure it gets into the minutes, because if someone were to just flip through this and see no green on a fund and see maintain,
Yep.
for the novice, they might say, geez, like, what'd you do that for?
Yep. That makes a lot of sense to me.
All right. So if there's anything I can do to help on the minutes or anything, let me know. But I just think the minutes will be important on a couple of these where it's sort of where the eyeball test is sort of challenged, I'll just say.
Great.
Is that fair?
Yep. Perfect. Sounds great to me.
Okay, cool.
So the rest of the funds here are a little bit easier to go through, all on maintain, all in good shape, performing well against their respective peers and benchmarks over shorter term time periods, and then also over those longer term time periods. So no concerns on our end from the investment menu. All of the funds outside of those two remain on maintain, and those the ones that are on discuss and watch, we're not elevating those above that, and just continue to monitor. So no recommended actions on our behalf on the DC plan. I want to be cognizant of time. Unless there's any questions, I can pass it over to Chris to go through the DB side.
I think we're good. Thank you. Thanks, Dan.
Problem.
All right, so we'll switch gears here before I bring up the screen. Just by way of an introduction, Chris Cashmore, also a partner at Fiducian, and work with Tyler and Dan closely on your relationship. And the orientations on my side, as mentioned, right, a little bit different. We've got the 3 pension plans in town and the OPEB trust. That little bit of different, right, approach there. So we'll show you the governance calendar and the intentions there, and it's very comprehensive, similar to the DC side of the ledger. Here we spent a lot of time talking about the complexion of markets, right? What's working, what's not, what is the actuarial considerations around the pension plans, right? What is the return target that the actuaries have? How is the portfolios, or how are the portfolios profiled over time to meet those objectives? And moreover, complexions of managers and their complementary kind of approaches, if you will, in kind of building thoughtful portfolios. So a little bit of a different animal, but the same kind of cadence, as you can imagine. So with that, let me bring up here. Can folks see the governance okay? That pop up yet?
I don't see a screen yet.
No, let me see here. Nothing yet, Art? Why is that not?
No.
Not showing on my screen. Let me try it again. Bear with me here. Share.
Are others just seeing the Brady Bunch screen
Yeah,
still as well?
Let's see if this worked.
There we go.
That's kind of
There we go. All right, I must have had it on the wrong monitor. Hold on here. I'm going to
there we go.
blow it up as well.
Yeah, I could see the fiduciary governance calendar slide.
Right. All right. Good. And so we're going to jump around here a little bit. We'll start just to kind of parallel what Tyler did on the introductory front here. Similarly, right, we've got a governance calendar that we use. Markets and portfolios and manager outcomes are obviously front and center every quarter, but there are other things that we attend to as well throughout the cycle. As you can see there, I won't go through each and every one, but I will focus for this quarter and this morning's meeting just on we are in the cycle now where we have, at the end of last year, updated all of our capital market assumptions. We've worked through all those assumptions, kind of expectations for markets and across the investing spectrum. We'll share that detail with you. And then we will take those data points and align them, marry them to your portfolio allocations, right? And kind of see if we're still on the rails in terms of the allocations and what we're trying to achieve with the programs. Lisa can jump in here as well, and other longstanding members with the pension plans target a 6.5% return actuarial right now. Funded status for the 3 plans. We don't have it. I don't think we have it in this. Yeah, no, we didn't put it in here, but are pretty strong and solid. And as we talked at the last meeting, for those who will remember, actuarially, you're in pretty solid standing when we look at some of the data versus your peers, for example.
Chris, just a quick update. Our actuary recommended that we do an additional experience study next year. So we'll be doing another experience study, so we'll have better funding handle on this.
Yeah, and that's a great point, Lisa, right? That your actuaries, periodically do like to step away and do some of that detailed work. So that's great to do that on a regular basis. Anyway, so here these are plans with long-term obligations, as we all know, right? So the framework we use is our longer dated 20-year capital market forecasts. And you can see here, we won't go through each and every data point, but you can see we share where we stood last year versus where we stand this year in terms of capital market return expectations. And you can see there a little bit of moderation, right? Particularly in fixed income and domestic equity. If you think about the complexion of returns in those two areas over the last couple of years, markets have done pretty well, as you know. When you think about valuations, which are certainly an input to our forecasting efforts, right? They're a bit elevated in those areas. It does create that, potential headwinds, and all else equal, right? When you look at where valuations are, the hurdles are a bit higher, and we want to be kind of cautious and thoughtful about that and react to that circumstance. So we're a little bit moderating in terms of expectations for fixed income. We're down about 20 basis points, you see there, for the broad U.S. investment grade markets. A little bit of a reduction in U.S. equities. You see there about 0.3%. I'm in the middle of the exhibit. And actually a slight tick up in international markets. As Dan mentioned, it was a particularly strong year for international markets last year, but they continue to play catch up a little bit, right, from a valuation perspective. And moreover, just in somewhat of a counterintuitive way, if you think about the conditioning effect maybe of what's going on in Washington, and tariffs are coming, they're not coming, tariffs are coming, they're not coming, we're modifying the amount of tariffs. You kind of put that all together, the world's kind of developed a little bit of a cadence in terms of how to, maybe treat that and react to it. So we think the international markets are poised to continue to do pretty well here over the forecast period. So these are all the inputs, right? And what does that mean in terms of the pension portfolios? And bear with me here, because I know it's a busy page. But what we do is we take your current asset class allocations at the individual market segment level. You see the lightly blue highlighted line here. And we are about, just for the record, we're about 37.5% fixed income by target today, as you can see. And then the balance of assets are in a mix of global equity and different types of real assets and real estate. And over the forecast period, you can see that the program currently is modeled to about a 7.1% return. Folks, I think, can see all that. I'm in the upper right-hand corner of the exhibit, and you can see the associated volatility with it. We do test different mixes as straw men, right? So we kind of go up and down the risk spectrum, if you will. We add a little bit more fixed income. We add a little bit more equity, and we kind of want to test the ramifications of that. As you can suspect, right, not a lot of change in terms of the forecasted outcomes, right? So the portfolios, as you would expect, this is maybe language I suspect that's familiar to some of you, but the portfolios are kind of statistically optimal. They plot on the efficient frontier, right? The suggestion being that you're adequately being compensated for the risk that you're bearing. The programs, as you'll see in a minute, are well diversified at the asset class level, and moreover at the individual manager and mandate level. So the programs are in pretty good working order. We don't have any recommendations for the committee this morning to make changes. We simply wanted to reaffirm the stances for the pension plans as we begin the new year. And you'll see there that we kind of build a measure of safety into those outcomes, right? Because these are median numbers. You all remember high school statistics, right? There's obviously variability around that median number, and we want to be mindful of that. So we kind of build a little bit of, I call it excess return, but you can appreciate there that that's, kind of loosely used, but nonetheless, we're kind of on the right side of the 6.5, but well diversified, in good working order, and don't have any suggestions again in terms of the portfolios, the pension portfolios. I'm going to pause there for a minute because I know I jumped around a lot. But anything from the committee that doesn't ring true or needs more detail around it?
Chris, just mostly for the public, we assume a 6.5%, but our forecast is 7.1. And can you just state for the public again, I think you just said it, that's the margin where it's being overly conservative. We're still using the 6.5 assumption. Can you talk
Exactly.
about the difference there?
Yeah, because of the variability inevitably in capital markets, right? And that those outcomes are median numbers, and that we know that there are not insignificant chances that you could do much better than that, or maybe not do quite as well, right? Those forecast periods, particularly, or forecasted outcomes in the front end of that forecast period, can be even more variable. So just as a measure of caution, right, we want to have the portfolios have the earnings power against that variability. So we build a little bit of excess return. Again, I'm calling it excess return. You all appreciate the nuance there. We just want to have a margin of safety over the ROA, the actuarial ROA. And that's pretty common practice across municipalities, right? They'll kind of recognize that they've got the ability to bear that risk, right? These are long-term plans. You're consistently funding them. The portfolios are liquid to the extent that we need, monies to service pensioners and the like. So there's no challenges there. So that's just the kind of the dynamic I think that the municipal arena is always operated with.
Hey, Chris, what about the placement of where we are on that efficient frontier? So I'm sort of a math nerd, so I get all the math you guys are doing behind that.
Yep.
I mean, you could obviously increase the 7.1 if you wanted to, but you'd be pushing further out on the right and you'd be taking more risk. I assume we're in a reasonable spot on that frontier if you think left to right where other pensions are and how you think about taking risk in a program like this.
Absolutely. Great question. Great question, Art. And you kind of see it here, right? So to the point, you can see, these portfolios are all statistically equally desirable, right? It's just, to your point, Art, right? It's just a matter of the risk bearing tolerance of the governing body, if you will, and you can absolutely scale up and down the horizon. For mature plans like yours, the mix of assets that we've got, risk assets versus fixed income. Is my math right? 62.5%, call it return seeking assets, 37.5% fixed income. Very, very commonplace, very consistent with other peers that have kind of similar demographics. And, we would argue again, right, that it kind of fits the bill nicely, right? It strikes that balance of incremental return and a 7 handle, if you will, on the forecasted return versus the 6.5, but doesn't get you too far out over your skis. And moreover, right, let me just go back here, if I could. You'll see here, right, and bear with me, what we call the equity risk premium, right? And that's the differential of, let's use U.S. large all cap, versus bonds. 140 basis points is that equity risk premium is pretty darn tight right now versus where it is historically. There's not a ton of incremental compensation, right, to bear more equity risk right now. You see that in some of the outcomes here, right? So sure. It's just not from our perspective, right, a right time to step into more risk, for example. Moreover, just pragmatically, right, think about just where we are with valuations and whatnot we talked about earlier. It would probably not intuitive, right, to the group to say, let's load up on more equity risk, just given where we've been over the last year or so with returns. But good question.
Great. Thank you.
Quickly here, I do want to be sensitive to time as well. So we run through that same exercise for the OPEB. The OPEB circumstances are a little bit different, right? A slightly less mature pool of capital, but nonetheless an important one and one that we've talked about in the past. The town has made great inroads on, and you're in very good standing in terms of the size of the OPEB trust. Similarly, we've kind of adopted, right, a balanced total return perspective here. You see 65% return-seeking assets and 35% fixed income. So a slightly higher measure of equity, just given the relative immaturity of the program vis-a-vis the pension plans. But diversified, well balanced, again, a 7+ type % return expectation here, and other circumstances kind of dovetailing with the pension. So no recommendations for the OPEB trust either in terms of the allocation of assets. We're going to get particular momentarily with those details for you, obviously, and where the actual managers and what's going on recently in just a second. But big picture, I think that the OPEB trust is in good working order as well. Any thoughts or questions or concerns there?
Any questions from the group? I think we're good.
All right, I am going to go, bear with me here. I'm going to go backwards in the deck for just a second, and I'm not going to spend a ton of time here. Tyler and Dan kind of hinted at some of this a backdrop, but I'll spend just a minute and a half here just to kind of get us caught up, and then we'll transition over to the portfolio reviews. So big picture, right? As we came in the end of the year, a couple of things just to kind of punctuate in terms of performance trends and what went on across markets. As Dan mentioned, I think a terrific year for international equities. Right. This is the first time in quite some time that international equities outpaced their U.S. counterparts, and did so to a pretty good magnitude, as you see there. And that came from a couple of things, right? It came from the fact that the dollar did weaken up a little bit. It came from the fact that, the valuation metrics at the beginning of last year were more favorable for the international markets, and the markets bid into that dislocation a little bit. And moreover, the backdrop overseas, just in terms of fundamentals, relief being offered by monetary authorities, those types of things were all kind of tailwinds, if you would, when you snap it together. So good year for international equity. Dan, I think, and Tyler also mentioned just the complexion of returns here in the U.S., right? For a long period running, they've been dominated by the hyperscalers, right? The big glamour tech names. And you certainly see that. This just shows you kind of our take at the magnitude of exposure to AI, right, in a very broad sense. One of the things, and it permeates the markets, right, to some extent, that trend is so powerful that you see measures of exposure across the equity markets. One of the things you'll see in the program in just a second when we transition over, we've tried to consciously allocate some capital away from those large cap names. You certainly have exposure to them by design, but we're trying to keep the portfolios balanced in other areas, just because that run in tech has been so prominent and dominant that, as we saw last year, right, on the international front, and we've seen very early year to date to an extent in the small cap names, there's been some sponsorship there away from the big tech trades. So we are, again, diversified and conscious of those exposures. I'm going to skip over the valuation details here. I know this is a busy page. I'll leave it with the committee if you'd like to look at it. You see here on the left-hand side, just the measures of valuation and expensiveness. The basic takeaway being, right, that the U.S. equity markets in particular, maybe most predominantly the large cap names, are a bit expensive, and things are elevated from a valuation perspective. Yields remain pretty tight in the fixed income arena. Spreads are pretty tight as well. So, we kind of entered the new year cautiously, and we saw that, right, just in terms of some of the forecast output that we just glanced at.
What's the translation of that, Chris? Like, is there any tactical move that is done there?
Good question, Art. I don't think there's anything tactical, right? I would tell you that if we use that data to kind of reinforce, you'll see in a minute, just the larger orientations of the programs, right? So again, as I mentioned, we're trying to just be thoughtful about capital deployment, about being allocated somewhat away from, right, that large cap trade to an extent. Baseline yields and fixed income are still enduring, right? They've come down a bit, but they're still decent. And spreads are tight, but they've been stable. And if you look at corporate fundamentals, right, there'd be some suggestions from pundits that you're continuing to get adequately compensated. So just things to be mindful of. I don't think there's necessarily a call to action on capital deployment. Right, we kind of run down the middle of the field here, as you know, just being diversified, being thoughtful with the collection of managers, the investment expense, and all that kind of thing. And I think we're in pretty good working order as the year takes hold here. I'm not going to spend more than 10 seconds here, but just maybe the final affirmation point, right? It was a pretty constructive year in capital markets, both fixed income, as you see there, top half of the page, and the left-hand side of the exhibit, and then moreover, as we've talked about ad nauseum here, right? Really good returns for global equities. The one thing I'll mention is a precursor before we jump over to the portfolios and do a quick review, just to kind of emphasize, as Dan had mentioned, and Tyler, I think, it was a curious year, right? So as well as the broad indices and markets did, it was generally a challenging year for particularly domestic equity management, and that low quality your rotation that we saw, that sponsorship was pretty adamant, where you saw non-earners, highly leveraged companies, no cash flow generating companies being bid up very aggressively. And a lot of the discipline active managers that we use tend to shy away from those areas. And that did present some kind of relative challenges to benchmark. So just as a kind of keep that in mind as we kind of work through some of the numbers momentarily. It begs the question, if I'm a committee member, right, is, okay, Chris, prove to us that quality, you say quality is important and it should work over time. And in fact, it does, right? I don't think we put the exhibits in the booklet today, but we can get them for you. Quality it wins over time as a factor. It did not last year. In a pretty decided fashion. So it was a bit of a challenging year for active management. Anyways, let me again pause quickly. I'm going to pull the screen down.
Chris, just a quick question. I think you have it later in the slides. What was the year-to-year rate of return that we?
Yeah, that's what we're going to jump to, Lisa, right now. So
but can you also, because we have two new members, there's the year-to-year. When you say year-to-year, you're meaning January to December 30th, or do you mean our fiscal year-to-year?
Yeah, we I don't know. I think we might have the fiscal year numbers today too, Lisa. But calendar year. We'll let's spend some time on calendar year, then we can kind of circle through on some of the fiscal year stuff, if that's okay.
Yeah, the reason why it's important to our board is because it's the fiscal year that is used to determine the annually required contribution.
Right. Exactly. And so, as you folks know, right? So, and then, so those June evaluations in the summer when we're meeting and talking about this, right, where we've got explicit data through the fiscal year ending in June, as Lisa mentioned, right, those are important data points, and we'll spend time on. Art, I know you mentioned you're an actuary, so you know this, right? The actuaries, just as an aside, right? They smooth investment returns, right? They don't give you credit in all the credit in really good years, nor do you take all the down in really bad years, right? They're trying to help you manage and stabilize the contribution year to year that the town makes. So there is a smoothing, that's a 5-year smoothing mechanism that they use through time, actual return to achieve versus, the targeted, the 6.5. So that'll be something we'll spend time on at the summer meeting for sure. But good question, Lisa. So let me just quickly here, because I've been probably droning on here much too long for the committee. Let's get you to the actual numbers here. And we're going to go kind of quickly. What I would mention, just all three pension plans, and I'm going to jump back and forth here. So all three pension plans, here's the town plan just as the sample for the group. And I say that and I start here because the portfolios, all three of them, share managers and share allocation, right? As we talked earlier, you see the target rates that we, percentages, that we looked at earlier. This is again, the town plan you see at the end of the calendar year, just shy of $34 million of invested assets. kind of, up and down. Here you see different types of strategy managers. The portfolio does make meaningful use of indexing, anchored in that large cap US space, which is tougher for active managers to harvest consistent incremental return. But we do, like fixed income to be active and international segments of it to be active. And you see here kind of a thoughtful mix of active and passive. The portfolio is in good working order, as Dan mentioned, right? Dodge and Cox Income on discuss. Obviously, that status carries over to the pension plans. But just to give you a quick sense of the portfolio at the end of the year, and we'll do the other two plans momentarily, and then you get performance. So Lisa, to your question, last year the portfolios are up 14% net of fees. And then you can kind of see the run rate here longer term. As we've talked about in the past, right, we always have great caution around these period specific numbers, right? Recent relative numbers can kind of leak in here, but then can be repaired very quickly when we get on the other side of the ledger, as we've been for long, portions of the tenure here. And really just for the committee, the relative numbers, we're certainly mindful of them, but they are absolutely a byproduct of what we talked about earlier, right? It being a bit of a struggle for the active managers. Neuberger Berman in particular, your domestic small and mid-cap manager, is a very much a quality-oriented approach, and it was obviously a difficult relative year for them, but you go back and you look at numbers, they were ahead from 2017 to 2022, consistently above benchmark and ranking well with peers. So again, we underwrite to that whole cycle as we talked about, and just wanted you to be mindful of that. So the other thing I would point out, right, just in terms of bogeys, right, actuarially 6.5%, and no surprise, right? When you start to expand the lens and look out over longer periods of time, you start to see those 7+% type numbers. Again, we're trying to tie the investment outcomes right over longer periods to that actuarial expectation. And the numbers sometimes we lose track and sight of, right? Over a $4 million investment gain for the town plan for the year ending in December. Again, I'm going to go quickly here. The Board of Ed.
Chris, one quick question before you switch.
Sure, Lisa.
On the other slide, it looks like and maybe I'm just reading the chart wrong. It looks like our portfolios miss the benchmark every year. Is that right? Am I reading that wrong?
Well, that's what I was saying, Lisa. Over these longer periods, as we sit here today, really a byproduct of just what happened over the last year relative to benchmark. I think, Lisa, if I didn't put it in the booklet, but if we went back and looked, hold on here, let me just.
Because it looks like for 10 years we missed the benchmark.
So for this particular period, because of that last year, right, and that magnitude, which is a little larger than it's historically been, you do see that. If we were to roll the clock back, right, and look at these same data points, for example, a year ago, those longer dated numbers would look much more competitive to the benchmark, right? It's really a byproduct of just what's happened recently that's kind of leaked into the intermediate numbers. So again, I mentioned earlier, I think we just need to be sensitive and aware that kind of points through the return cycle here, right? That relative number is going to bounce around a little bit around the benchmark. We've got long periods of time, right, where we've outpaced the benchmark, or the managers, I should say, have. So it's certainly, again, something we're mindful of, and I think it repairs pretty quickly if the markets broaden out the way we think that they will, right? And you should be positioned to capture that. And when quality returns is a rewarded factor, which it has historically absolutely been the case, right? And we'll see those relative numbers tighten up the benchmark.
How do you sort of square that with some of this press where Warren Buffett, that index always outperform active. I mean, I get your point on international and on some of the other investments, but how do you sort of reconcile those?
We do a lot of research on it, and we try to look at, segments of the markets where there's proof statements and data that suggest active works over longer periods of time. As we've talked about, we don't think it makes sense to spend investment fee dollars in domestic large cap, right? Let's index that. The small cap markets, excuse me, quality does work over time, and Neuberger kind of plays that trade successfully, as we saw there. Fixed income, right? You get a squirrely interest rate environment and some changes maybe forthcoming. Active management can make sense, and overseas as well, there's some evidence of sustainability. So to your question, Lisa, right, it's a balancing act. We want to keep the program cost efficient. We're not going to spend, dollars unnecessarily. And, you've got about a third of your program in indexed right now. And moreover, the active managers where they are, to the points that Dan made, right, typically are significantly cheaper than the peer averages in those categories, right? We're always kind of doing due diligence on where we're active, doing it in a cost-effective manner. So they all kind of bubble up into trying to be thoughtful and balanced around the complexion of the program. And I think you do kind of hit the markers on that in terms of the mix.
Kelsey, I would just ask, the minutes reflect, if this is accurate, Chris, that our fees are below benchmark. Is that right? Is that what I just heard you say?
Well, yeah, but for where the managers are, where we use active management, the fees are below benchmark. I might say, right, Lisa, because obviously the index is the index. But yes, for the actively management mandates, your fees generally are below benchmark.
Which is about,
or I should say below median. Excuse me.
Which is about 2/3 of the allocation is active. Is that right, Chris?
That's right, Art. Yeah,
okay.
Exactly. So again, I think am I running over, Kelsey? I think I might be. And I do want to obviously be respectful of people's days and everything. So I'm going to, the exact same thing here, right? For the Board of Ed plan, similar outcomes, right? A $4 million investment gain there as well. Obviously the same complexion at the portfolio level. And finally, police plan again, right? Similarly, and same type of complexion there. And you can see about a little over $11 million of aggregate investment gains last year for the three plans, and then running to an aggregate asset value of just shy of $93 million at the end of the year. And then this is another thing. I'm going to jump again, Lisa, here. I know we've talked about this. So the OPEB trust has grown up in a little bit of a different environment. So we're currently all indexed there. And we've talked to the committee a little bit, and the portfolio as it exists today is, we'll probably work with Amy and staff, right? It'd probably do for a little bit of rebalancing here as we come into the new year. But generally diversified, right? Using ETFs for the time being. And one of the things and fixed income, domestic, international equity, all the things that folks are familiar with. And one of the things we've talked about over time, and we haven't tackled it just yet. I know, Lisa, this is a little bit of a stepwise function, right, with your Board of Finance, but we've talked about now at this size whether it begins to make sense to bring in some active management or not. We can continue to have that discussion. One of the things we did talk about, not to muddy the waters, but maybe for the new members, just to have a little bit of an accounting of, we did, bear with me, my screen is frozen here. Here we go. There we go. One of the things we did talk about, right, is we can probably transition from those ETFs to traditional indexed funds if the board and the committee so chooses. We've had this conversation a little bit. We haven't come full terms on it yet, but you do see there we could save some additional fees if there was an appetite to do that. There's a little bit of a cost, right, of trading out of the ETFs, but we did some math around it. I think we would take about 2 quarters to recover the transaction costs of doing that trading, where the lower fee would kind of, dominate on a go-forward basis, if that makes sense. So again, I'm not sure, Lisa, jump in here, right? I'm not sure that's an action item today. We just didn't want to make the new group aware of that circumstance. And I think
when would we bring that for a question? Because it feels like you'd want to have and maybe it would be just a little bit more of a deep dive than what you had on that page, Chris, but it would probably be good for us to make an overt decision there. Is there a natural point in one of our quarterly agendas that would fit, or do we have to make that a special topic at some point?
I was going to say, right, we didn't, it's a great question, Art. I might defer to the group, but maybe from a governance perspective, for example, if at the next meeting in the spring, right, if we made it maybe an actionable item for, the committee's consideration and a definitive.
Does anyone see a problem with that? It feels like it's a pretty straightforward conversation, assuming, Chris, you would have the right, that gives you enough time to put the right information together for
sure.
a decision.
Absolutely. Yeah, that's plenty.
Yeah. So just process-wise, so that the retirement committee would consult on it. So we'd obviously give the Board of Ed and Board of Selectmen, then the decision would be made at the finance level.
Okay, so we would just be voting to make a recommendation. Those boards actually have the final decision. Okay.
Right.
Fine. I just like us being in a stance of being proactive on all these things. So you guys will probably see that in my style is when we know something, let's not delay it more than a quarter to get the information together and try to make a decision then. And I get your point, Lisa, we just have to remember that we're not actually making the reallocation decision. We're making a recommendation.
Okay. So maybe if it suits the committee, Art, and through the chair, obviously, if we'll get a little bit more detailed maybe for the spring meeting, and
let's do that
forth and have it on the agenda as a discussion item and an item for action. And I think that's a good suggestion.
Perfect. And I would imagine that the analysis will be pretty straightforward because you already have the different charges. We can have a view of the typical net returns and what we're giving up, et cetera. But I get the point. It's probably a pretty straightforward decision.
Right. Yeah. ETFs were practical at the time, right? And now that the portfolio sized up, you can extract some fee concessions out of going to direct, traditional mutual funds.
Okay. Great.
So that is, Mr. Chairman, that's all I had on our side. I know I'm running a little long here, so I will shut up and get out of the way here. Unless questions.
No, we appreciate your thoroughness. Any other questions for Chris or Dan?
Before you got on, I've just confirmed with Chris, we may end up having Tyler. They're supposed to come to the full board in our February meeting. Okay. So we'll have that.
Okay.
And then after the May meeting, at our regular meeting, we could then take action on any recommendations that we get.
Okay, great.
Okay.
Thank you. Okay, are there other agenda items at this point? All right, do we need a motion to adjourn then? Or do we just adjourn?
I mean, I'll move it, but there's no one else, so you can second.
All right, I'll second it. We're good. Appreciate all the work here, guys. Thank you for the engagement.
All right, thank you too for the good questions, folks. We'll see you soon.
All right, have a great day, everyone.
Have a good day, everyone.
For over 40 years, SCM has been the voice of our town,
bringing us together through local programming,
education, and live broadcasts.
SCM isn't just about television.
It's about empowering our community,
ensuring our voices are heard during government meetings,
and celebrating milestones
like our high school graduations.
But today, SCM faces a challenge.
Our funding structure is based on television subscriptions.
And it's no secret, people have been cutting the cord.
With a shift to internet-only subscriptions,
SCM receives less revenue,
even though all our programming is freely available online.
We need your support.
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 Your donation can make a difference.
It will ensure that SCM remains open,
continues to educate our youth,
and keeps our community informed.
Thanks to SCM, I've been honing my creative skills, helping me work towards my college degree.
SCM is crucial for keeping our community connected.
SCM isn't just here to broadcast local events.
They're actually preserving Simsbury's history.
Join us.
Join us in preserving Simsbury's voice.
Simsbury's voice.
Together we can ensure that SCM continues to thrive
for generations to come.
Visit our website
or scan the QR code on your screen to make your donation.
Every contribution
counts.
Thank you for supporting Simsbury Community Media,
where your town,
your schools,
and your government
come together.